What's up guys, today I'll be talking about why short-term fluctuations don't matter in the stock market. My name is Kevin Murray and this channel is all about personal finance tips and long-term investing. Sit down and just think about it. If I'm making an investment, making long-term decisions for myself, I have an outlook of between 3 and 5 years for my investments. I don't care what happens to the market day to day, if it had a bad earnings report, or if mainstream media is talking how the market is in a bubble right now, or the next crash is going to happen in the next month or even a couple of months down the line. You got to cut everything out, short-term drama. Historically, the market has been always going up. I'll pull a graph up right here, and if we look at it, historically the market has been going up because of innovation. The economies in the world have been increasing production, technology advances. In some instances, the market goes down for a period of time, like crashes. We could look at 1999 to 2001. That was called the dot-com bubble. The dot-com bubble was the spark of the internet. It was changing the world, not in the short term, but in the long term. Investors were investing into companies that had no revenue and investing into a story. Their valuations don't make sense. They didn't have that correct mindset, actually invest correctly in the market. They didn't read financial statements like 10Ks, understanding their basic business model, risk factors, and numbers. They just chose a company that had a lot of hype and invested in it. And look what happened. It went down. And then we can look at 2007 and 8 and 9, the financial crisis. We saw the market going up and then it went straight down. And what happened during that time period? If you asked your parents, you probably know, the banks got a little too greedy, loaned out money that wasn't supposed to be loaned out to people that had poor credit, had no income, and they couldn't essentially pay it in the short term. And what happened? Foreclosure. The demand for houses weren't there. There was a lot of supply, so the market went down. It was called the financial crisis, just summarizing it in under 30 seconds. Like I said, the stock market has historically gone up. And one of the best times to buy, if you study the market with simple logic, the best times to buy in the market is when everyone's selling, when there's panic and fear, when things are discounted, and the market has always recovered. It sometimes took years, sometimes it took even months. But it's all about having a patient game and thinking long term. Most people only care what happens to their portfolio day to day. Oh, I made a couple thousand. Oh, wow, I lost a couple thousand. They have that short-term mindset about investing. And true wealth is created over time, letting compounding work for you, being patient with it, unemotional, and being disciplined. And you can't predict where the market's going to go in the short term, but in the long term, it has historically gone up. We see right now, 2021, no one can predict the market in the short term. We're at all-time highs right now. Could we see a little correction in the back half of the year? Things correcting itself so valuations catch up with their earnings? A lot of new people have gotten into the market. People just want to make quick money, dumping stocks after a couple months of holding it and paying high taxes on them. Real wealth is created over time. Sure, you can make a couple thousand in the short term, but what about a couple million in the long term? You see? That's the $1 million question. But if you have that mindset ingrained into yourself, I'm making long-term decisions. I don't care what happens in the short term. It's a nuisance and you just gotta enjoy your life. And when there are downturns in the market, that's why you always have cash available in your account. I always say have between 20 and 30% of cash available so you could be on offense, buying on the dip. Those are the best times to buy when things are discounted. Index funds, individual stocks you love in your portfolio. And if you're young like me, you could take a lot of risk in investing into individual stocks. You gotta understand what you're doing. Reading the 10K, having that mindset right, knowing how valuations take an effect in the short term and long term, understanding the competition, and knowing who runs this company. Do you resonate with their business model? If you have confidence and done your research on picking individual stocks, you shouldn't be caring what happens in the short term. You're investing in a business for the long term because you see potential in it. You see they're changing their industry for the long term. We can see what happened with Amazon or even Facebook and how they changed their industries on a whole different level. And who's going to be the next Facebook or Amazon? No one could predict that. But it's investing in companies that you see potential in undervalued. Peter Lynch, he's a very famous investor in the stock market, and he said, common sense investing is the way to go. Investing in companies that you use each and every single day, A, because you understand their business model, and B, you have a competitive advantage. Wall Street makes complex spreadsheets, projections, but you're on the field testing their products and using it each and every single day. So you see people are talking about their products from your friends and family. If it's good or positive, you can talk to the managers in store and see what the sell-through rate is. And also, the market's very volatile, meaning it goes up and down a lot in the short term. From mainstream media, selling news that's very clickbaity, very emotionally. They do that on purpose. Number 2, earnings reports. Every 3 months, publicly traded companies report earnings, and investors can see how this company performed each quarter, if their revenues are growing, if they're profitable, or if they're losing money. These companies publish a 10Q, which shows their financial numbers, in a conference call that gives you an outlook of the short-term and long-term longevity of the market of that specific company. Is it good or bad? How is the management team portraying this company? Do they have confidence? How is their vibe? Are they answering questions specifically, or are they giving vague questions? So as an investor, I want to see confidence in their management team, growing your revenues, and having that long-term mindset. If you don't understand where you're investing, why are you investing in the first place? If you're just listening to TikTokers or YouTubers and just investing into stocks they are saying to invest in the short term, you might make money, but in the long term, it's not very sustainable. And B, you're not going to build confidence in yourself making long-term decisions in the market. I consider myself as a long-term investor. My majority of my stocks that I own, specifically, that I understand on a high level, are growth stocks. They're very volatile. But with my age and my time horizons and just learning how the market functions and doing my correct research, I'm training myself to be unemotional and not caring about the short-term fluctuations. Every month, I checked on the latest news of my specific companies. I record every 3 months. I see how financially well is this company. Are the revenues growing year over year? So it takes a lot of work if you want to pick individual stocks. It's not about just buying and forgetting about it in the cabinet. There's more work to it under the surface. It's all about experiencing market when you're young, like in high school and college, experiencing the short-term fluctuations and volatility. So over time, you become wiser in learning how the market functions. It's all psychology. Most people invest irrationally. They care about the short-term fluctuations and like short-term price actions. You're investing into a business for the long term, not in the short term. Who's going to be in it for the long term? We'll see. The new investors or the weak investors have already gotten out of the market. The real investors that want to create real wealth are in it for the long term. That's how it is. Nothing in life, there's no such thing as getting rich in life quickly. It's a process. It's going to be a journey. Life is a marathon, right? One of the positives of being a long-term investor, you don't have to pay as much taxes. And most Americans, if you hold a stock or a business or an asset for more than a year, it's a fixed rate of 15%. But if you hold a stock for less than a year, less than 365 days, you're taxed on your individual income level. If you're taxed at 20%, you're going to be taxed 20% of your short-term gains. So that's why the government incentivizes people to invest for the long term, because you pay less taxes. And that's how the game works. And just kind of wrapping up this video. Know what you're investing in the first place. Do you have confidence? And the stock market has historically gone up, and most of it, it's just simple psychology. Buy and hold, and that's it. There's no complex strategies to it. Know their valuations, which I talk about later in my videos. Who's running it, their competition. Thank you for watching, and peace out.